This is the reason why we are primary option sellers, because your win zone, your win probabilities are so much higher. You don't have to be right directionally to win, to make money. Under this SPY, I want to talk about the call versus the put option. I want to talk about number one, the basic characteristics of each, and then number two, the profit loss scenarios for each. So three pillars that we consider. What is the call and the put, and what's happening when you buy and sell a call and the put? That is the first pillar, and that's this image that you see on your screen. The second pillar is the options chain, because that's how you buy and sell and understand your probabilities, is the option chain. And then the third pillar is basic option strategies. Right? If you understand the basic option strategies, you'll be able to understand all the different exotic things that we create here at the Dorian Trader and others create outside of the Dorian Trader. I want to talk about basically the first pillar, but talk about it a little differently, not using this chart, but I encourage you to jump into course 1, lesson 2, and go over the basics. It goes over these three pillars. It uses this chart, and it gives you, it's a robust type of understanding of options as we could within that time frame, right? You can always use that as your base and then continue to build upon it. Right? You want to be awesome at the base of options. You want to understand those three pillars at a very, very high level, and it will pay off or pay dividends as you continue your learning journey in this options world. But today I want to show is that concept on the actual option chain and kind of break it down. And I want to do it by starting off by doing something like this. So let's start with the buying of a call and the buying of a put. This is what you would probably see in an options basic book. They'll start you off by talking about buying. And I know the books that I've read when I first started learning about options, and they encouraged and talked mostly about being the buyer of options and how you can define your risk by being the buyer. So I want you to see how this looks on the screen here, and then let's break down the dynamics of it. So most people start with being the buyer of this call here. When you're learning about options, you're the buyer of the call, because when you are the buyer of a call, it's very similar to being the buyer of shares. When you buy shares, you want it to go up. That's how you win. If it stays the same, you lose because you're losing opportunity cost. If it goes down, you actually lose absolute dollar amounts or money. When you are the buyer of a call, you need that same concept. You need it to go up. If it stays the same, you lose. If it goes down, you lose. But if you're the buyer of a call, it's even worse than buying shares, because if it doesn't go up enough, you still lose. You really only have one way, especially if you're buying a call out of the money, you really only have one way to win. And that's, it has to go up, and it has to go up in a big amount that supersedes the monies that you paid, especially if we're talking about expiration. And that's what options are usually based on. They're based, or probabilities of options are usually based on at expiration, because that's the equilibrium. Everything is the same at that point. It's so much dynamics that happens in between the time you put on the trade and the expiration that the models can't factor that in, because it's dynamic. It's constantly changing, but it can 100% factor in what are your odds at expiration. Before we continue with the video, I just want to quickly point out, if you need any additional help, please consider joining our trading club. You can do that by clicking on the link in the description area, and you'll get a 3-month trial for a flat fee of $60. We look forward to seeing you in the trading club. Back to the video. And so if you are the buyer of a call, you have what is called a right. You have a right to purchase at a strike price. So in this example, you have the right to purchase at this $5.97 strike price. You do not have an obligation, so you don't have to do it. You can just let it play out, and you can sell it even if it's deep in the money. You do not have to buy the shares unless you want to. As long as you don't let it expire in the money, you do not have to worry about being assignment, because you have a right. That's the same with the put side, when we'll talk about that here in a second. I want you to understand the dynamics of this call. You pay monies, and if it goes at expiration, if it's higher than what you paid, meaning if we paid this, for easy math, if we paid $10 for this strike here, then you would need it to be at 607 or past that to be able to win at expiration, right? Because you have to supersede the amounts you are paying to be able to win at expiration. Can it go up sooner than that? Can you win before expiration? Yes. And that's what we encourage people to do if they buy. Because if you wait to expiration, your odds, if you're the buyer of a single option, call or put, your odds are almost always, almost 100% of the time, if not 100% of the time, less than 50-50. Okay? So you want to make sure you are exiting buying when you're the buyer. You want to exit at before expiration when you have a decent amount of profit, 50%, something like that. Exit the trade. All right, so looking at this put side, when you buy the put, you actually want it to go down. You are bearish on the underlying. And so this is where options become confusing for most right away because it's counterintuitive to what we are accustomed to when we are the buyer of something. When we are the buyer of shares, when we're the buyer of something outside of the stock market, we usually want it to go up in value so we can sell it for more, right? So if we're a buyer of the house, we want it to go up in value. Now, the put, though, you actually want it to go down in value so you can sell it for less. That's what's kind of counterintuitive. We're buying something and we want it to actually go down so we can sell it for less than what we purchased it for. It's being bearish. The most you can lose is the monies you paid for the put, but you need that underlining to go down more than what you paid for you to make anything at expiration. Just like on that call side, you need it to go up at expiration more than what you paid. So the put is bearish. You're paying monies. At expiration, you need it to supersede what you paid. And you have a right to sell, but not an obligation. Just like on the call side, you have a right and not an obligation. So you do not have to sell the shares. You can just exit your put option. But if once again, if you let that expire into money, just like the call side, you will let the brokerage firm know that you want to exercise your right. So the dynamics is that you're buying both. Monies are coming out of your account for both. You have a right for both, but one is bullish, which is the call purchase, and one is bearish, which is the put purchase. And you want to understand it very, very clearly. You want to understand what's happening, and you want to understand your rights, and you want to understand your probabilities. When you're the buyer of an option out of the money, the delta you buy it at is your probability of success at expiration. It doesn't mean you can't win before expiration, as I mentioned, and that's what you want to do. You want to take stuff off before expiration. If you hold to expiration, if you're a buyer of a single put or call, you're going to have at best 50-50. Most of the time, 99+% of the time, it's going to be less than 50-50 shot if you're the buyer of an option out of the money. Actually, if you're the buyer of an option, a single option in the money or out of the money, that's going to be the case. Okay. Even if it's deep in the money. You might have people out there on YouTube telling you the best way to buy is to buy deep in the money. Well, your probabilities at best, and most of the time, still less than 50-50 if you hold something to expiration. The only difference when you're buying something in the money is that you're going to still have tangible value, what is called intrinsic value, still going to have some value. It's not going to be worthless. When it expires out of the money, this is the out of the money area on the call side, and this is the out of the money area on the put side. When it expires in this area, the options are always worthless. There's no value at all. But if they expire in the money area, like this is the in the money area here on the call side, and this is the in the money area on the put side, they're not going to be worthless. Okay, they're not going to be worthless in this area. I should square this one out. They're not going to be worthless in this area, this in the money area. Doesn't mean you're going to win, but you're not going to lose everything. If you're the purchaser, you're not going to lose everything if it's in the money. It's still going to have some tangible or real value. So you want to understand that. All right. If we flip this, you guys, and we are the seller, in this case, I just want you to understand the dynamics, the different characteristics of each type of option, the call and the put. As you guys know, it's only two type of options, a call and a put, and you can either be buying it or selling the call or the put, or you can be doing a combination when you're doing spreads and things like that. But right now, I'm talking about kind of a single sale of the put and a single sale of the call. If you are the seller of a call, then you are bearish. Monies are coming into your account that you never have to give back, but you want the stock or the underlining that you're doing it on, you want it to go down if you are the seller of a call. You have an obligation. You don't no longer have a right. If you're the buyer, you have the right. If you're the seller of the call, you have an obligation to sell the shares to the buyer. And your obligation is at the strike price, the 597 strike price here. The difference with this one, though, is that when you're the buyer, the only way you win is that it has to go up and enough to supersede what you paid, as we talked about a second ago. The seller of a call, which is bearish, it can win even if the stock goes up. Obviously, it's going to win if it goes down. It's going to win right away, immediately, if the underlying goes down, the stock goes down. It can also win if it stays the same, right? If it doesn't move very much, it can win. And it can also win if it goes up. As long as it doesn't go up significantly enough or big enough to supersede the premium that you receive when you sell that option. This is the reason why we are primary option sellers, because your win zone, your win probabilities are so much higher. You don't have to be right directionally to win, to make money. I can say that I think the market is going to do X, and even if it does Y, I can still win. Okay, I can still make money. And so in this case, if that's just for easy math, you guys, if this was $10 I was paying, it would have to go up past 607 before I lose at expiration. It would have to supersede the premium that I receive if I was selling this, I should say. If I was selling this for $10, I know it's 9 right now, but just for easy math, if I was selling this for $10, for me to lose, it has to supersede that $10. I like to tell members or people that whoever that I'm teaching regarding options is that, do the analogy of the insurance company, right? You pay Geico $1,000 to insure your car for 6 months. You also have $1,000 deductible, right? You get into a car accident. Geico doesn't lose on you until the car accident supersedes $2,000. It has to supersede the premium you paid them and the deductible you have of $1,000 for them to lose. If it does not, even if it comes close, they still don't technically lose on you. If you did get in an accident and they didn't technically lose on you, they're going to increase your rate going forward, right? So they didn't win what they wanted to win, which is the $1,000 on you. They're going to increase your rate going forward. And if they did lose on you, they most definitely going to increase your rate going forward. That's how we operate, right? I just say we received $10 for selling this call, and we get out with a small win of, let's say, 50 cents. Well, if we're going to put on the call again, we're going to expect more now. We're going to have a high probability again, and we're going to expect more for the risk if we deem the risk to be higher, just like the insurance company. If you are the seller of the call, you have an obligation to sell shares at the strike price, and that's mostly going to happen when it's in the money. That's when the probability of you having to live up to your obligation is higher, when it's in the money. If you are the seller of a put, then you have the obligation to purchase at a strike price. So in this case, you have to purchase at the 588. But just like the call side, you don't lose until the drop supersedes how much you received when you sold the option. So if you sold the option for $9 here and it's at the 588, it has to fall more than $9 at expiration for you to lose. So your probabilities are high that that's not the case, because once again, it has to supersede the premium that someone's paying you for that insurance policy. You have the obligation to purchase shares. The word obligation has a negative connotation, but you guys know it's not that case in the options world, because we are the primary seller when the options in the options world, and that means we're the insurance company, that means we're the casino, that means we have the odds on our side. We have a probabilistic edge when we are the option seller.